From downtown Milwaukee, welcome to Money Talk with Bob Landis. Each week, professional advisors from Landis & Company Investments discuss the latest financial developments, offering timely insight and long-term perspective.
This is Money Talk for March 20th, 2026. Coming up Thursday is the Brewers home opener with the White Sox at 1:10 in the afternoon. And your Milwaukee Bucks are on the road all week, with or without Giannis. And speaking of basketball, the madness has started. And for the next 3 weeks, every bar, no matter their theme, will magically become a sports bar. All right, let's get started with a falling birth rate in Russia. The government is referring women to psychologists because of the dwindling birth rate. Seems to me it's not the birth, but the 18 years that follow that have women saying yet. One of the most popular women on the planet is Jessica Foster. She's had her picture taken with Donald and Melania Trump, Vladimir Putin, Ukrainian President Zelensky, and lastly, her photos are being used as a recruiting tool for the Make America Great Again campaign. But you're probably way ahead of me. That's right, she's AI. Scientists believe turbulent space weather around distant stars could be scrambling potential alien signals before they even reach Earth. In spite of what these rocket scientists say, I think the aliens have already been here, and they see no reason to come back. On the podcast today, we have Tom Pappenfus, Dave Sandstrom, and wrapping up the week, here's Joel Driesing.
Thanks, Max, coming from a true rocket scientist. So, rough week. We had some fallout on the stock market, and bonds went up. The NASDAQ fell 2.1% this week. That was 458 points. The Dow Jones Industrial Average fell 2.1%, or 981 points. And the S&P 500 was down 1.9%, or 126 points, and 100 of that was just today on Friday. For the year so far, NASDAQ is down 6.8%, the Dow Jones is down 5%, and the S&P 500 is down 4.9%. Mentioned the bonds, the U.S., the benchmark U.S. 10-year Treasury went up 11 basis points this week and is now at 4.39%. It started the year at 4.16%. I guess most of what we've been seeing on the news this week is about the war, the Israel and U.S. War in Iran, and that continued to seem to weigh on stock and bond markets this week. One place the war came up was with the Federal Reserve Board. As anticipated, the Federal Open Market Committee, the policymaking group from the Federal Reserve, decided to hold rates steady. They said that partly because of the uncertainty of the fallout from the war, they couldn't really justify lowering rates right now. They also said that the economy is pretty strong, all things considered, and that even though the job market is kind of in flux and inflation rate is still higher than they'd want it to be, but they held steady on that. Dave, do you want to weigh in a little bit about that and what it means to long-term investors?
Well, Joel, I think the Federal Reserve, just by their mandate in general, they're looking to provide stability for both employment and for prices across the economy. So the last thing you want is a Federal Reserve that is going to be making knee-jerk decisions during times of high uncertainty. And certainly with what's going on right now in the Persian Gulf and the inability to move oil around the world, we're certainly faced with a lot of uncertainty. I think it was prudent on their part to kind of pause here. With inflation kind of taking a jump, with gas prices going through the roof as a result of the war, you're even getting some pundits out there starting to suggest that the Fed might be forced to go the other way. So here we are having a conversation a month ago about here come the Fed rate cuts, and suddenly here we are sitting on top of people suggesting they might be raising rates. So it's no wonder that the markets have taken a negative opinion of this, and why interest rates have spiked.
Right. Tom, have you had discussions with clients about these sorts of things and the war in general and what it means to their portfolios?
Yeah, I mean, I think to kind of echo or piggyback on what Dave was saying is, right now, I mean, we're, a couple weeks into this. It's too early to make any, I think, rational or reasonable adjustments based on what has happened so far. As we have seen in the past, things can quickly do a 180 from where they are today, as they have done. I think a lot of this has caught a lot of people by surprise. And so you're seeing a knee-jerk reaction initially here, but justified because we are seeing higher prices in oil, higher prices in gas, ultimately higher interest rates, a number of issues that are really important to investors. So, I think the general messaging is right now is just kind of like our Federal Reserve, Chairperson Powell has said, is just wait and see kind of how things play out. I mean, the best strategy in this moment is you're in the storm already, is to kind of hunker down and kind of play the game we've been playing all along, which is remain diversified.
Yeah, Tom, I agree. This is a great time to just refer to your fundamentals, right? Look at where our valuations right now. We've been talking, almost ad nauseum for the last year about how expensive stocks have been. We've seen PEs elevated for quite some time, and I think they, especially in the tech sector, peaked last fall, where investors were paying just unbelievable premiums compared to what you'd pay on average for those same companies over the last 20 years. PEs approaching some very, very high levels. So we're getting a little relief in that area right now. Valuations becoming more attractive.
It's a silver lining of the prices going down.
Exactly. I mean, obviously it's still painful, but it doesn't change the fact that it's been a long time since we've been able to look at the stock market and say, hey, it looks more attractive from a price perspective. And I would suggest that where P's are still elevated, we're still looking at premiums across the board. But I think this is a time to start kind of changing your thought process a little bit and wondering and asking yourself, is there an opportunity coming on the horizon here?
Well, and I think, kind of what you touched on a little bit as well, Dave, is, underneath all of this, underneath all the turmoil, the chaos, and the unpredictability right now, is nothing has really, and we talked about this just before we got on here, is, are companies less profitable all of a sudden in 2 weeks' time? Are they less profitable? I mean, we're heading into this year at 14% earnings growth, and it sounds like, I think, Dave, you were maybe mentioning a number before that might even be higher than that for year-end forecasts. We still haven't seen, you're looking at analysts and forecasters that aren't yet adjusting their models, their numbers for lower earnings growth, lower economic GDP growth as well. Until those numbers start to change, and again, time will probably be that predictor, or I should say, start to tell that story. Then then you can start to feel a little bit different about where things are at. But I mean, our average client right now, and I can only speak to myself, is only down maybe 1% or 2% in a lot of cases, and a lot of people think it's much worse, just because what you're reading and what you're seeing out there, it's justifiably scary or unsettling, but. At the end of it, the diversification is working fairly well, and people are holding up pretty well in this.
And earnings forecasts are still pretty rosy, and we talk about that earnings and interest rates are the two things that drive stocks and wealth over longer periods of time. And let's talk a little bit about interest rates. So the 10-year Treasury going up as much as it's gone up so far this year, what sorts of effects does that have on portfolios?
Well, it's certainly a little painful, obviously. Rates run in the opposite direction of prices. So when rates spike like this, you take a little bit of hit on your bond portfolio. But I think, again, big picture, the 10-year, anytime it's in that low 4% range, you're historically looking at a fairly normal range. I think people forget we spent 10 or 15 years in the abnormal world of zero interest rate when the 10-year was in the 2% range for quite a while. So, a 4% 10-year Treasury note anywhere between 4 and 4.5, I think is a pretty reasonable place to be. And again, I think this is driven by some of the earlier week's fears about the Fed possibly raising rates. So I think we're seeing that volatility in the bond market as well.
And these aren't higher rates that are affecting like bank accounts or CDs savings yet.
No, I think you'll see that's more closely going to be tied to the Fed rate. And obviously, I think it's a long shot that the Fed's going to turn around and start raising rates right away. I think things would have to get a lot worse before we start to see that. And I still wouldn't take a rate cut off the table for this year. I think if we can get some resolution in the Middle East and we start to see oil flowing again out of the Persian Gulf, I wouldn't put it off the table for a late year rate cut.
Well, I remember, I think in podcasts of just recent years past, we've talked about, with higher interest rates, the amount of cash that has been built up on the sidelines, the amount of treasury bonds, treasury bills, and things like that. And as Dave noted before, we haven't had a lot of opportunity to get that money into markets. So now we're in a point of time where interest rates aren't quite as high as they were when we were having that conversation a year or 2 years ago. So they've come down, but now we're getting a potential catalyst for some new monies to be deployed into equities again. That just hasn't been there in a long time. And for the time it was there, let's say you go back to April of last year, you had a very narrow window to kind of make that work and kind of come to terms with, hey, am I ready to do this? And when we had the kind of the reaction to tariffs, but now we're getting another opportunity, which I think is probably going to be more of the run-of-the-mill sell-off, perhaps correction, depending on how far this goes. But there'll be a little bit more of a larger window, I believe, to get in.
Joel, I know it's been hard to concentrate on anything other than the war this week with the coverage out there, but I know there was a few economic indicators that you
there were a few, actually more this week than there will be next week. But so I look at those daily and send notes around the office. But basically, we have positive indicators on industrial production and factory orders, not anything that is shooting the lights out, but it's positive signs. We still know that inflation is sticky. It's still above where the Fed wants it to be, which is 2%. It hasn't been at 2% since 2021, so 5 years. So, and we had numbers this week on the wholesale level of inflation. That was a year-to-year rate of 3.4%. That actually went up. It was the most it's been in a year. Then there's the housing market. We had some numbers on pending home sales and new home sales. Both of those were lower than we'd like them to be. The pending home sales, basically we've been watching home sales at about a 30-year low. Those aren't changing that much, partly because of inventory. We don't have enough houses out there to move people around into new places. And then we also had some numbers on the market for labor, the unemployment insurance claims. And the term I repeated last week was we're sort of in a no fire, no hire zone as far as employers are concerned. They're not adding jobs, and they're kind of loath to get rid of workers, because if they lose workers and need them again, they don't know where to get them. So those are all kind of like repeating themes. They are where we are right now, and the Fed reflected that when they talked about where they are as far as looking at what they're doing with interest rates. And again, as you said, it's the uncertainty out there that's putting them in a position of playing wait and see. And they weren't alone. The central banks for the Bank of England, Switzerland, Sweden, Japan, Canada, Australia, the European Central Bank, they all basically said the same thing this week, that they're not going to touch their rates for now because there's just too much uncertainty out there for the war. Tom, you're talking about opportunities for cash. I noticed this week that there are some estimates that tax refunds this year are 10% ahead of where they were last year as far as the median amount that people are getting. Is that something that you talk about with clients coming into the office this around tax time? If they're asking, hey, what should I do with this tax refund, or is that a discussion that you usually have about how you manage tax refunds?
It's part. I mean, just depending on the size of the refund, depending on the client's position. Are they retired? Are they dependent upon money? Are they about to retire? I mean, I think just specifically as it relates, I mean, I can speak to clients that have, maybe retired or have some extra funds that are available and kind of what to do. And again, for the right risk tolerance, right risk appetite, if you will, this can be a buying opportunity right now, as we've talked about already. I think it does present a good opportunity. The fundamentals on a longer term basis haven't changed yet. You have to emphasize the yet part of that. And so, I try to be optimistic, also at the same time realistic, that there's good opportunities out there. And I think if you're someone that is, again, everything's all in time frames. So I always try to frame it in, well, how quickly do you need funds? Are you 6 to 12 months? You're probably better served, especially in this kind of volatile time, that you should probably keep it, close to you. If you are looking beyond that, and depending on, how you can get by from other means, then it may, not be a bad idea to start tiptoeing in.
I think, Joe, some of the bigger average tax refunds are a result of some of the new tax laws. We've seen seniors get relief at the federal level, as well as the state of Wisconsin not charging taxes on some of the retirement income as well. So I think now is a pretty good time to look at, your withholding going forward for this year if you ended up with a very large tax refund. Because remember, this is not magic money. This isn't somebody deciding to give you.
You're letting the government use your money.
This is your money being returned to you. So I would prefer not to give the federal government several months or a year's worth of my money for free, only to have them turn around and give it back to me in next April. So if you did get a very large return this year, I'd probably want to have you sit down and look and see, okay, what should I do with my withholding for this year? Or if I'm making quarterly payments, adjust those to try to get closer to a break even for next year.
We also had news this week, or an update anyway, that the Securities and Exchange Commission is looking at making rules that would no longer require publicly held companies to have quarterly reports and to do twice-a-year reports instead. And they're proposing this in part to save companies money and the hassle of having to do those quarterly reports. But we were having discussions earlier today about other consequences that could bring, and whether it's a win for investors or not. I
think my personal view is that I think it's kind of a bit of a rat race, and going through quarterly reports and having markets react, and having markets and people spend billions of dollars digesting and analyzing and waiting for those numbers. I can go back to my MBA classes where there's Harvard review studies about how they train future CEOs and future CFOs to massage numbers to just beat quarterly estimates. We've gone away from decades old kind of, I think, I'd say more, trying to think of a good word for just kind of, companies that cared about their impact on their community and the world around them and kind of what they do, and focus on just, winning every 3 months. And you kind of lose what is your mission statement, what's your focus, and things like that. So in my view, I think it could be a beneficial thing. It's, there's other aspects of, where markets aren't as waiting in the wings and investors for those every 3 month numbers, that it can hopefully reduce volatility for the average client. And so I kind of tend to think that it should maybe smooth some of that out, where a lot of clients do get unnerved by all the trading that happens. And we talked a little bit about algorithmic trading and all the volatility that happens on a day-to-day basis now.
I agree with Tom. I think ultimately it could provide for a little bit lower volatility on these quarterly reports. And I've always thought it's really not a great way to run a business, just trying to hit quarterly numbers. I think it creates some short-termism. I think CEOs are just so bent on getting those numbers to match that they may not make the best decision for the organization for the next year or two.
There's also the belief that taking that quarterly requirement away might encourage more companies to go public too.
Again, reducing costs, right, and all that guidance and oversight, and massive accounting and legal bills that go along with every quarterly report. So yeah, there's tremendous amounts of money being spent on these things.
Well, with that, we enjoy having this podcast, and thanks for listening to us, and we'll see you again next week.
Thank you for listening to Money Talk with Bob Landis. If you have a financial question you want answered on next week's show, email it to moneytalk@landis.com. To keep informed throughout the week, visit our Money Talk page at landis.com.